All right, so thank you for joining me here today. So we're going to go over a lot of different topics that should be applicable to you as loan officers. And if there's any particular topics you want us to focus a little bit more in detail on, let me know. Again, for those of you who just joined us, please feel free to ask questions anywhere throughout today's webinar. It's meant to be interactive. It's meant to be applicable to what you need to know and what you want. You can use the chat or you can just unmute yourself. Either way is fine. Like I said, we just want it to be something you find beneficial. So these loan officer Q&As we do once a month on different topics. Today's Q&A is going to be more of a general look at a lot of the common topics that most loan officers want to hear more about. And then we do go into each of these topics in greater detail. So specifically, we'll have webinars on that go more in depth on sudden credit score drops or handling collections and things of that sort. One of our more popular ones is handling defaulted student loans as well, and exactly what to do in those situations. So before we get into the topics for today, I just want to start by explaining why I am here talking to you about everything. So why am I qualified to be having this discussion here with you today? So I own Insight Strategies Credit Repair. We're a credit repair organization that focuses specifically on helping borrowers who have a goal of home ownership. So our client base is all focused on obtaining mortgages. This means we work very closely with both realtors and especially loan officers. And my background prior to opening my company here was working for about a decade with some of the biggest banks in the country, where I managed adherence to the laws and regulations for default, modification, foreclosure, and the short sale process. So in that side of the industry, my job was basically to understand everything where everything comes to play when it comes to credit reporting, how things can report, and what actions banks and other financial institutions can take with anything derogatory when it comes to consumer reporting. So with that, we will move on and get into the actual meat and potatoes of today. Okay. So why do we offer these webinars to loan officers? And bear with me as I'm admitting people in while we're getting started here, so I may pause from time to time. So credit is one of the top reasons why a borrower is denied when applying for the mortgage. In the past decade, the median credit score for mortgages has increased by 20 points, according to the Housing Finance and Policy Center. If we look further back into 2005, it actually has increased far past those initial 20 points that we've seen just in the last 10 years. And yet, according to the data that's been made available to us, Americans took record number of mortgages in 2020. And fourth quarter of 2020 saw 1.2 trillion in new home loans, according to the New York Federal Reserve. So how does this really make any sense, right? We see an increase in the average credit score, but also an increase in loans that have been completed. So the two statistics have very opposing stories, but if we dig deeper into the data, it shows that most Americans with excellent credit scores with a median of 786 were the ones that really benefited. And many of the new mortgages were just refinances because they were trying to take advantage of the low mortgage rates. And not everyone could take advantage of the mortgage rates, of course, and now we're even seeing rates continue to climb. So credit access is historically very tight, with a median credit score of new mortgages continuing to increase pretty steadily since 2008. So now, since we are entering a time of even more rate increases, it creates more compression, and it makes it even harder for borrowers to qualify, which is something I don't really need to tell you as loan officers. So those borrowers who have already secured mortgages at great rates are likely not to refinance and not to move into a new property if they don't have to, because they want to preserve their low rates. So we may start to see a rush of consumers trying to secure a mortgage while they can, if we haven't already started to see that, which means we might start even seeing more and more applicants who may not fall into that easy scenario of really great credit and really great income. So now it's becoming more and more important than ever before to have a process to keep your pipeline full for those situations that aren't just cut and dry and very easy. So that brings us to the agenda today, handling 7 credit score drops during the mortgage application process, how to handle collections when they pop up on your borrower's credit reports, what to do when rapid rescoring doesn't help quite enough, and then solutions for your borrowers who don't have credit scores. And then open Q&A as well. And for those of you who joined recently, please ask questions throughout this. You can use the chat option or feel free to just unmute yourself as well. So again, I want it to be interactive and applicable to you. So I'd like to start by looking at the credit score algorithm, because as loan officers, having a strong understanding of the algorithm and how it works can put you far ahead of your other competitors. You can also be a resource for your borrowers in providing them with answers that may seem simple to you, but are very awe-inspiring to them. Making yourself stand out against your peers can help lead you to more referrals from those clients that you helped already. And I'm not expecting or asking you to be this giant expert in credit, because you already have to be an expert in your industry. You already have to be an expert in lending. But what I am offering is the ability to be able to solve some of the more common scenarios and help borrowers either secure better terms or be able to qualify in the first place. So credit score algorithm. This algorithm derives the numbers, obviously, that you see when you pull the credit reports. So ranked from the top, payment history is going to be the most important. So of course, this is looking at delinquencies, any derogatory information. I don't think I need to go into that too much. Capacity and amount owed is going to be the utilization. So that's going to be the credit limits versus the actual balances on open accounts, specifically on lines of credit. The length or the average time that that consumer has had credit also factors in that 15%. And then the final 2 sections are going to be the mix between types of accounts, installment accounts versus lines of credit, and then new credit, which is really just going to be how many new accounts they have open plus the amount of inquiries. Now, what's super important for you as loan officers is to know that even though we have, go back a slide, there we go. Even though we have this algorithm that has these 5 factors, the way those 5 factors are interpreted can vary depending on which version of FICO is being used. So I bring this up because often you have borrowers come to you that have an idea of what their credit score is. And they may come to you saying, I have a 700, you pull their credit, and all of a sudden it's not 700, right? It's 650 or whatever. So the FICO algorithm used in lending is towards the bottom here. I should bring out my pointer so you can see what I'm pointing at right here. FICO's 2, 5, and 4. So these are older versions of FICO. So over time, what happens is a new iteration of the algorithm is released, which is based on changes in consumer behavior. So the FICO score is meant to assess risk. So as things change, like let's say high mortgage balance is no longer give an indication that someone may go past due on a credit card, right? They adjust the algorithm accordingly. So where we are now today is with all these different iterations of, all these different iterations of FICO that exist. And in mortgage lending, you're still using the older versions of FICO, meaning it's a little bit more, it's a little bit harder on the consumer, a little bit less forgiving. So often when someone is going, let's say, and checking their credit scores, even if they're going on Experian.com, they're getting that FICO score 8, which is the most widely used version, just not in mortgage lending. So you will still see differences in the scores when you pull them on your end. Does anyone have any questions on FICO versions or algorithms? Just touching on it on a pretty light level today. Okay, we will move on. Okay, so let's get into the topics I know you are actually here for. So we're going to start by talking about sudden drops in credit scores that you may see throughout the mortgage application process, most of the common causes of those drops, and what you can do about it. So One of the more common factors leading to a sudden drop in score changes is credit utilization. And credit utilization is 30% of that credit score algorithm. So again, it impacts lines of credit and credit cards. So balances on credit cards and lines of credit are reported typically a few days before the statement date. So let's say you have that borrower who uses their full credit limit every month or close to it, but they always pay off their cards. If they're not timing it perfectly, it could cause an increase in the utilization ratio on their credit report, and it could cause some volatility in their score, especially if they have what's known as more of a thin credit file. Really, that just means someone with limited history or someone who doesn't have a lot of open accounts. Their credit score is going to be more volatile in nature just because there's less open accounts to create cushion for some of the blows. So you can resolve credit utilization changes through rapid rescoring, right? Essentially, if you can prove that that account has been paid down, you can use rapid rescoring to update the balance to 0, and you'll see the adjustment in the credit score. You can also tell your borrower as they enter the application process for the mortgage, just to resist using credit cards for the time being. You can explain to them why and what can happen, exactly what we had just mentioned. And this can prevent you even needing to use rapid rescoring in the first place and having that high stress, oh no situation come up, especially when you're going in to try to lock in the rate. So, I mean, that's pretty much it with credit utilization. It's one of the easy peasy solutions that you can solve just by reducing that balance. Now, let's say you have a situation where your borrower has a high amount of credit card debt and it's just not possible for them to pay off the balances. In some cases, it may make sense for that borrower to do a consolidation loan. Now, you're obviously going to want to consider debt to income ratio because their minimum payments in many cases may be higher when they do a consolidation loan, because now it's an amortized principal and interest payment. But what's going to happen is the second that those credit card balances are paid to 0, their scores are going to shoot up significantly. And this could get you to that credit score range that they want to have more favorable terms on the mortgage that they've applied for. Again, you'll have to consider, of course, debt to income and whether that's a complication in that situation, but it can create quite a bit higher of a credit score to allow you to move forward with the mortgage process. All right. All right, so that brings us to closing a credit card. Let's go back to that example and let's say that borrower took out a consolidation loan to pay off their credit card balances. You don't want them to close the credit cards. And I'll explain why. So if we go back to the credit score algorithm, I'm gonna go all the way back here. When we close that credit card, what happens is it impacts multiple categories here on the credit score algorithm. So let me get this laser pen out again. Okay. So a credit card itself is going to impact payment history every month, even if it has a 0 balance, it's adding positive payment history. It's impacting utilization, right? They have a 0 balance and great utilization ratio, right? It's at 0%, let's say at a 0 balance, that's positively impacting this factor of the score. And then when they close the account, we can see a big impact also in the length of credit history, because now all of a sudden that borrower has decreased the average age of open accounts on their credit report. Let's say that credit card was open for 10 years, 15 years, and they suddenly close it. That average age of accounts may shrink down considerably. Let's say their next oldest account is 3 years old. All of a sudden they shrink their average age of open accounts and we see a big drop in scores. So we see it impacting so many sections of that credit score algorithm through these 3 categories right there. Make sense? Hopefully. All right. I think I touched on every point there. And if they do close the card, sometimes they can get the creditor to reopen it. Not always, but sometimes they can get them to reopen it if they call really quickly after they after they first closed it, but often this is something that's really hard to undo. Okay. Borrowers paying off secured debt. This is another cause of a sudden score drop. So I'm going to touch on this in a little bit more detail because sometimes we do, I understand because of debt to income ratio, we may need a borrower to pay off a debt as part of the mortgage process. And many borrowers will go into the mortgage process believing that if they pay off their debt, it will help their credit scores. Specifically secured debt, right? So this is going to be anything like an auto loan. I mean, even an unsecured personal loan, this would apply to as well. I should really say installment debt here. But unfortunately, them paying off that debt does not help the credit score. Closing the account adjusts that average age of accounts of open accounts on the borrower's credit report, like we looked at from the previous slide. And again, this is 15% of the credit score. Pretty much any open account has a heavier weighting in the credit score model. I think that's the easiest way to think about it. An individual who has a thin credit file is going to see significantly more of a negative impact when they do this, meaning let's say it's someone with only 4 or 5 accounts on their report. I mean, you may see a huge drop in score, double-digit drop. So what's our solution? If you need a borrower to pay off a debt, let's say an auto loan, or they want to pay off secured debt as part of the loan process, the suggestion would be to have it come in, have the payoff occur at closing. Having the payoff be part of closing eliminates the issue where it's going to update on your credit on the credit reports and then drop the score before you're done with the loan process. So I won't dwell in that one too much more, but any questions at all on that or the prior category? Okay, we'll move on. So I think this one's a pretty self-explanatory one. Sudden drop could also come from a new derogatory account or late payment. We see this happen all the time during the process with our partners. So it could be a sudden Comcast bill, or a utility company bill that just pops on the report, or a medical bill from a copay from 6 months ago that all of a sudden appears. So sometimes collections come without warning. Sometimes our borrowers don't know that they owed something. Maybe there wasn't a proper notice from the collection agency. That is not unusual, unfortunately. And sometimes it may only appear on one bureau and not another. So you may be safe, right? Depending on which bureau had their middle score and which one you were actually using to qualify. So consumers are required to receive written notice regarding new collection accounts before they appear on the report. It just doesn't happen often, even though it is the law. But if you do encounter a situation like this, one of the worst things you can do is tell that borrower to pay the collection, because unfortunately it's not going to solve the situation. It's not going to remove it from their credit report unless that collection agency agrees to remove it in exchange for payment, and they want to get that in writing. So if your borrower does receive a collection notice and they actually tell you about it, and it's not on the credit report, don't tell them to ignore it. They're going to want to take action right away, because it may just be in that 30-day waiting period before it appears on the report. And it's best to seek a professional, and that's something we can always help you out with if your borrower encounters that situation. Okay. So let's talk a little bit more about collections. So where collections fit in the credit score calculation is the payment history. So it's the biggest overall factor. So this is not necessarily a question of whether you're able to get the mortgage with the collection showing on the credit report, not really necessarily looking at the amount of the collection or anything like that, based on requirements of whatever type of product you're trying to fit that borrower in. It's more about how it impacts the score itself. So let's say you have a borrower who has like a 740 credit score, and they all of a sudden have a Comcast collection pop in on their credit report. That can drop them up to 100 points because it's part of that biggest overall factor of the credit score. But also the algorithm essentially looks at that and says, oh, this is unusual behavior for this borrower, this type of consumer. This must mean they're having payment troubles. This must mean they're at higher risk. So we may not want to lend to them, right? Maybe they're having payment issues. It's not smart enough algorithm to say, you know, a $30 collection from Comcast isn't a true risk. It just sees collection risk. So you may see a massive drop in credit score from that collection. So digging into the FICO models a little bit more, a consumer, I bring this up to you specifically because a consumer may be looking at their credit scores as we looked at earlier in the webinar on Experian or on somewhere like Credit Karma, which Credit Karma isn't even a FICO score, it's a Vantage score. And they may see that, oh, because I paid my collection, my credit score increased. So they assume that when they come to you and you pull their credit, their score is going to be up as well. But with those older versions of FICO that you're using in mortgage lending, the 2, 4, and 5, a paid collection is just as negatively impacts the credit score as an unpaid collection. Where it is different now is the newer versions of FICO 9 and 10, but you don't use these versions. And the Vantage score that they see on Credit Karma rewards them, increases their credit score for paying a collection. So that can cause some inconsistencies and some confusion on the borrower side when you're working with them. So this is more just a section to make sure you are aware of that. And again, paid collections just show up as paid in full or settled. They do not help the credit score when paid with the mortgage version of FICO. But your borrower does have the option of doing a pay for delete or working with a credit repair organization like ourselves to work to remove it. Pay for delete is, of course, going to be the faster option. They offer payment in exchange for the account being removed from the credit report. Not every collection company will do this, and sometimes that borrower shouldn't necessarily take that action if that collection company is not operating under legal parameters, which is not uncommon either, unfortunately. Okay. I think I kind of already mentioned that. Don't instruct borrowers to pay collection accounts with, I should add the caveat, with the goal of seeing an increase to their credit score, just because you may not get that increase. So we'll move on. So next topic, what to do when rapid rescoring doesn't help enough. So let's start by talking about what rapid rescoring actually does do well. So it provides estimations on score increases for paying down credit card balances. That's what it does really well. So you can think of rapid rescoring as a way of essentially fast tracking updates to credit report information. So instead of having to wait till a creditor would typically update the information with the credit bureaus, you're accelerating that timeline. And so it will identify when, typically, most commonly, when making payments is a good idea. Some models will look at, you know, if a collection's removed, how it will help their credit score and things like that. But most models that most lenders are using have quite a bit more limitations than that. So some of the limitations, or the universal limitations, are it can't identify when adding information to a credit report can help the score. What's that mean exactly? So when we're looking at credit reports for the borrowers that we work with, for our loan officers, we're looking at that algorithm that we looked at on the very first page, right? Or beginning of this webinar. And we're saying, is there a way we can add information to the credit report that's going to cause an increase in credit scores that's quick? You know, it depends on, the speed depends on what the options are, right? Some things are pretty immediate, some things take a month or two. And if there's something missing from their credit picture that can improve their scores, we're going to be able to identify that, where the rapid rescoring model cannot necessarily do that. So we may recommend adding rental payment history, or we may recommend adding a borrower as an authorized user to a particular account of a spouse's, things of that sort. There's all sorts of other things we can do. But whatever we can do to create quick increases to the credit score, so you can give that borrower the terms that they're looking for or qualify them in the first place for a mortgage is something that can be done when rapid rescoring just isn't quite getting you there. And then the other obvious option is the actual credit repair process, right? If you have a borrower that's in the 400s and 500s and they're not wanting to go through with getting the mortgage at 580, or maybe they're not even close to that, maybe it doesn't make sense. Going through the credit repair process can be a way where they're focused not only on the removal of derogatory information off the credit report, but also how to add that good information. So you can see that turnaround time in as little as 6 months to get them to the high 6s, or if they're willing to wait the 8 months, that's when they typically can get into the 700s. Okay, so let's go to some solutions for borrowers with no credit scores. This is one of the simplest solutions. Now this is, I'm scrolling. Now this is applicable to ITIN as well. So what we offer for individuals that do not have a credit score populated is a credit establishment plan. It takes about 1 to 3 months. Average credit scores start in the 700s for those individuals. So just because somebody has no credit doesn't mean that we can't create a score very quickly and turn that around. Now, there are going to be, of course, other requirements for ITIN as far as needing to have established credit in the US for a set period of time, depending on the lender. But there's a lot of options, and they're a lot quicker than most loan officers may have realized that we have available. So, and at good rates once they are, once their scores are populated. Scores, I mean, high scores once the scores populate. You get what I'm saying. Okay, so we had some questions that were submitted ahead of time that I'll go through, and then we'll open it up to open Q&A. Okay, whoops. I think I went too far, sorry. Okay, here we go. When helping people with credit repair, do you dispute late payments even if there's a balance left on the account? So we can dispute late payments if they're non-compliant with the Fair Credit Reporting Act. So there are times where you may have a borrower and you're looking at a merged credit report, so you don't get to see the differences between how the Experian credit file looks, how the Equifax credit file looks, and how the TransUnion credit file looks. And when we go through our repair process, we're looking at those differences. And sometimes what we see is the late payment may have been placed on the wrong month on the credit report. Maybe the borrower was late in June, but it shows in July. Maybe it shows in June on TransUnion, but Equifax and Experian show July. Those errors would allow for a removal of that late information only because the Fair Credit Reporting Act says that it must be consistent across the bureaus. And what most people don't know is the bureaus are siloed. They don't actually communicate with one another unless it's something like a fraud alert that's been placed or a credit freeze that's been placed on a credit file. So it is something that can be helped with. It's not necessarily an overnight process. No credit repair really is like a quick turnaround. There's some things that can be quick, but an entire credit repair process usually takes about the 6 months to 8 months timeframe. Okay, next question that was submitted is there anything that can be done about student loans in default? So I mentioned this a little bit in the beginning of the presentation, webinar, whatever. Student loans in default can go through a rehabilitation process. Sometimes that, depending on the product, it may be required to be pulled out of default. So the rehabilitation process can be as quick as 1 month, or if they have a repayment plan because they can't afford to pull it out of default, that repayment plan can be 6 months, can be 3 months. It really just depends on affordability for that borrower. But once they are pulled out of default, it's going to create a brand new student loan with a brand new trade line on the credit report, starting fresh, starting off with all on-time payment history, right? So that old loan still exists on the report, but no longer shows in default or in collections. And now they're starting fresh with new payment history, and you actually have a payment that's been calculated too, which is a benefit because once it's in default, there's no payment calculated on that balance on the report. So hopefully that answers that question. Oh, I missed a question in chat. Okay, I'm going to answer the chat question, then we'll come back to this. what are some of the options to raise their scores for Social Security borrower, ITIN borrower? No rental payment history, authorized user, is there credit cards that I recommend? So for anyone that goes through our process for either credit repair or just establishing a credit score, we give them about 12 different options. So there's a lot. There are credit builder accounts that are savings accounts that report like loans. We have several secured credit cards and unsecured credit cards. We have about 12 different ones that we've vetted for our borrowers. We have some that, you know, we've branded as well, too, but it'll just depend on exactly their credit file and how thin their credit file is. If it's somebody who has not a lot of history, but let's say they have a massive amount of collections, let's say they have 5, 6 or more, that's not a ton, but 5 or 6 collections and maybe only 2 open accounts, we're probably going to recommend them to add rental payment history, subscription services, utility bills. We're probably going to recommend they open secured cards. It really just depends, but one of the quicker ways we can see progress in scores is by utilizing credit cards since, and let's see if it lets me go all the way back. I'm going to go click a bunch, bear with me. Wait. Okay, one of the quickest ways to increase scores is through proper utilization of the credit cards, because it impacts almost every category: payment history, the utilization, types of credit used right away. And then we'll use authorized users for the length of credit history to create longevity there. So we're really just picking this apart and saying, how can we use the least amount of tools to maximize the most amount of growth in credit score for the rebuilding options or the establishment options. And that's why we can get a high score so quickly, whether it's through creating a credit score in the first place or rebuilding. So hopefully that answered you, Yvette, and if that didn't, let me know. Okay, let's see, did I answer this one already? Okay, we did that one. So next submitted question is, I have a borrower who is showing a late mark on a mortgage when there was a servicer transfer, but they said they were never late. Is this something that can be fixed? Absolutely. This is a different set of laws. So it's not, I mean, it's partially covered in the Fair Credit Reporting Act, but also covered in some other regulations when it comes to the mortgage industry in general. It's not uncommon to see, unfortunately. But there's 60 days from a servicer transfer. That's kind of like a grace period in case there's payment errors that occur. So that's something that can be fixed. One of the more common things we're seeing right now too is when a borrower was in forbearance during COVID, a lot of errors with reporting derogatorily on credit during an active forbearance. There are some complications and intricacies there, so each situation needs to be looked at specifically. But we have, especially over the last 2 years, seen a lot of mortgage late mark errors, which is a really big one, especially if you have requirements that they need to be current for a year before getting a new mortgage. So that's pretty much it. So basically, this slide just meant to show that only about 50% of loan officers look for improvement potential. And this was based on a national survey. And so if you're thinking about only 50% or only half of loan officers looking for improvement potential, you have a lot of opportunity for borrowers that thought they either couldn't qualify for a mortgage or were unhappy with the terms to make them happy. Which means your pipeline could be exceptionally larger. And people that you thought couldn't qualify and people that you've done a lot of work for that never became borrowers because you didn't know what options were available, you can now help. So our whole goal, sorry if that was loud, our whole goal as an organization is to help support you and help our clients who are your borrowers get to that goal of homeownership and get good terms too. So we want to be a part of your sales funnel. And we want to help not only borrowers, but loan officers to understand more about credit and how it works. So today was more focused just on solutions, but if you are interested in learning more about the models and the structure of credit, I encourage you to attend some of our other webinars that we host. So we do consumer webinars once a month, loan officer webinars once a month as well. And then if you want to partner with us, you're welcome to partner with us too. For any loan officers that partner with us, we offer access to a partnership portal where you can track the progress of the referred borrowers. And we offer ongoing communication where we include you on anytime we're cheering that client or that borrower on when they see really big score jumps. And then we also offer free reviews of credit reports. So if you have a credit report you want us to review to see what options are available, you can always ask us. And then with that, I'll leave it open to what questions you have that we haven't already covered or topics that you want to explore further. Feel free to speak up or use the chat.
I have a question.
Go for it.
I'm not sure if you covered it. I jumped on a little late, but I have a client where wife has a Chase card, $6,000 limit, a few $100 on it. So we added the husband, the co-borrower, onto that. With her not being on the loan, just him, we needed to bump his score. And the authorized credit card shows up now with the score dropped like 15 points. And I'm thinking, because it's a new trade line, but he doesn't have a lot of utilization for the other two credit cards he has. So I'm just looking to see, get some perspective on that.
It shouldn't show as a new account necessarily, because the age of that account is going to be based on when she opened it. And I don't know if I missed when you, how old the account was for her. Was it brand new or was it something that had been open a while?
It's been open a while. Yeah, it's been open a little while. So I'm doing a soft pull and it showed that it dropped. So that's the only thing that I saw that changed. So maybe that's why I'm not doing an actual hard pull. But the overall utilization should be higher. I was thinking I was gonna bump his score up.
Yeah, it's likely something else that may be impacting it. Do you have a snapshot of what the report was before? Did you have a soft pull before versus a soft pull now?
I have a soft before and a hard before and just a soft now.
Okay, that's fine. I am happy to look at it and I can give you an indication of what happened. That one's probably gonna have to be a little more specific where we look at it in more depth. It might not.
That'd be great.
Be
So you want to do that after this call, or?
Yeah, I'll shoot you in the chat. I'll put my email and feel free, anyone can feel free to reply. Shoot me over an email and we'll plan some time and we can look at it. I have a secure link where you can upload it, or if you,
okay, cool.
Your option too. So another question was, what is the average cost for credit repair? So we have two different prices. One for somebody establishing credit, one-time fee of $50 for us to provide the plan. For the full credit repair process, we have an initial fee of $250, which gives them the credit building plan, or rebuilding plan, if you will, as well as our educational platform. So that includes videos, a written education, and then coming July 1st, an additional interactive platform that's going to have, I don't even know how many hours of content at this point. I think we're probably on the low end 6+ hours of content. And then they pay $110 a month for our process. We do have them have credit monitoring, which is $30 a month. We also offer the mortgage scores for the credit monitoring. So it's gonna have FICO 8 plus all the industry specific scores, including the mortgage. So it's the real scores that you're using to qualify them for. It's not an inquiry, nothing like that, when it comes to the credit monitoring. So what other questions? Oh, and usually people are with us 6 to 8 months. There's no contract, so they can end the process at any time, but most, if they're in the 400 to 500s, it's about 6 to 8 months to get them to the 700s. So hopefully that answers your question there. What other questions do you have? You can ask anything under the sun, anything credit related to your borrowers, the algorithms. Quiet bunch today. Well, I will say we partner with loan officers all over the country. If you end up wanting to work with us, shoot me an email there. Or on our website, you can also check out the partnership page and you can submit a request to become a partner. I'm putting our website here, insightsstrategies.credit. And then just as you have questions, use this as a resource. The most important thing is to make sure both you and borrowers get good information on credit and how credit works. It is very complicated and it's very convoluted. On the surface, it seems easy, but it gets quite complicated when we start layering in the different algorithms, and especially the mortgage algorithm, which is just much harder on consumers, with things not being time weighted the same, and with things just being more harsh as the model is just not updated for the way the consumer is behaving today, unfortunately. So anyone have any other questions? We've still got quite a few of us in here. Feel free to use the chat. Actually, let me stop sharing my screen. You don't need to look at that anymore. Any specific situations anyone has come across lately that have put a halt on a mortgage? How does the rescoring work? Like the rapid rescoring, is that what you mean, Tracy? So each lender has their own internal, like wherever you pull credit scores from, they'll have the rapid rescore option. Sometimes it's called CreditWise. Sometimes there's different names for it, but essentially you can go in there and run scenarios, and those scenarios will let you know what the options are for that particular borrower. And sometimes it will have results that just aren't doable for your borrower. Let's say it's paying off large amounts of debt. That's going to be where you want to reach out to a professional. But sometimes it gives you what you need, and then you might get that extra 10, 15 points, whatever your borrower needed in that situation for the better terms. So kind of a general answer, but you may have to ask your branch specifically how it works internally, but that's essentially what it's looking for.
I have a question. You hear me?
Yeah.
Why in some scenarios it tells you to pay off a charged account, but not a charge off instead of an active collection?
Great question. So a couple different reasons. So a charge off account is typically, in most cases, going to be a credit card. So you're no longer going to have a credit limit extended to you. So now you have a line of credit with zero credit extended and a balance. It's going to throw the utilization out of whack. So it can have an impact there. You pay that off, that can help. A collection's different, right? With a collection account, there's no utilization ratio. So it's never going to pull in and say, pay off the collection. It'll help your score. If it says anything, it's going to say remove the collection and it'll help your score. And so it could be that account was more impactful than, let's say, an open credit card that somebody had because the utilization was decent on that open card. I'll go one step further too. A lot of consumers have heard the myth that if they pay a charged off account, that it will reset that 7-year timer for how long it can stay on the credit report, but that's false. Basically, the 7-year timer starts from the date of that delinquency, that original delinquency. And when you pay an account that's already charged off, it doesn't make the account current. So it doesn't reset that timer. So it's still based on the original delinquency. Does that answer your question?
Yeah, it did. Austin, it made sense too now when you said that. So
okay.
Thank you so much.
Awesome. What other questions do you have? I will have a recording of the webinar. So for those of you who weren't able to join right away, I'll send a copy of that out within the next day or so, couple days, give me a couple days. So that way you can either use it as a resource or see the pieces that you missed. But again, always feel free to reach out to me for any specific scenarios. Like I said, you'll have my contact information when I send out the recording, so you can reply to me there, or feel free to check us out on our website as well. With that, I will end unless there are any additional questions.
I'll throw one out there again because I have it up on my screen. Is what is the quickest way to get a credit score with no scores showing, no history, 2 student loans sitting there, and that's it?
Yeah. So I'm going to defer to our plan that we build. So we basically have an option of 12 different steps. If you want really what you need, like the formula that you need is at least 2 open and active accounts that you're paying on, right? So sometimes if they have deferred student loans, it's an open account, but there's no active payments reporting. So it's kind of a toss up on whether a score will be generated. But quick ways: open a credit card. If they have difficulty finding one, let me know. I can give you tons of resources there. Authorized user on a family member or spouse's account. For the love of God, do not let anybody, if they ever ask you about buying trade lines, do not let them do that. Because if you give them a mortgage after they've purchased trade lines, it's mortgage fraud. So I'm just throwing that out there. If you've heard of it, being in the industry you're in, definitely don't let anybody use purchase trade lines when they're going through the mortgage process with you. Piggybacking is legal. Purchasing trade lines is illegal. So.
Thank you.
Any other questions? Don't be shy. Okay, it sounds like that is all we have for today. So we will keep you posted when I have another webinar coming up. Also, feel free to check the Eventbrite. There's a page for Insight Strategies, and you can see all the upcoming webinars. Most recent one coming next is going to be on collections. And then, like I said, I will also send out a recording of this webinar. It will be available on YouTube as well, along with our past webinars. And then again, use this as a resource. If you need anything, reach out to me, and myself or my team will be happy to help. All right. Well, thank you everyone so much for attending in the middle of your workday. Appreciate it. I'll talk to you all soon.